I've gotten a lot of good questions regarding different topics over the past couple of months. So what we're going to do is I will create quick 5-minute videos that you can kind of scan through and come back to if need be. All we're going to do is focus on the moving averages this video to give you a better idea of what they are. I'm just going to use 4 different moving averages. 2 are simple moving averages, whereas the other 2 are exponential moving averages. The only difference between the type are exponential moving averages are more reactive than simple moving averages. So let's start here looking at this chart of Tesla, and we're going to be jumping around this particular stock. But what I want you to understand is there are levels to this. So you have to think about it this way. Price action is king. It should always be your main focal point. The moving averages are indicators, therefore they're secondary. But you have to kind of think of everything on this chart as being your world, and I'm going to elaborate on that, but just remember this chart is your world, and that's going to help us determine the significance of each moving average. And that's because moving averages are not created equal. There is strength in each of these lines, and that strength varies predicated upon the line and the time of that line. So if you're looking at the 200-day moving average, and this chart is the Earth, that moving average is the equivalent of a continent. That's how you need to look at it. That's how much mass it carries. It's how significant that moving average is. Then we have the 50 moving average. Think about that as a country within the continent, right? It's completely affected by this 200 moving average, but it still has significant strength because of its correlation to the continent. The 21-day, think of it as a castle in the country. Does it have relevance? Absolutely. It does not have nearly the significance of the 50 or the 200-day, not even close. However, it does still have significance. And then you have your 10-day, which you can kind of think of as your outer wall of the castle. And if you like the shorter term moving averages, you can include your 5-day moving average. And you can kind of think of that as like a moat. So that should give you kind of a clear picture as to the varying significance of these lines. I don't really want to get too much more specific than that, but let me give you a couple more things. You can see how price has some sort of reaction off all these different moving averages. We're either respecting and bouncing off them or rejecting off those lines. And that's because they are what is referred to as dynamic support or resistance levels. And all that means is they are support and resistance levels that are constantly moving. Now, let's also take into account who's buying at these levels. The people that are buying a bounce off the 10 EMA, they're your day traders or perhaps swing traders. It's not institutional buyers. So the 10 EMA is basically for people that are day trading or are taking a trade in effort to catch a quick multi-day move, like momentum traders. That's who this moving average will offer the most value to. The 21 EMA, you're basically looking at your smaller funds and your high net worth kind of guys that are looking at this and going, okay, well, if price goes here, I can get in and out without getting hurt too bad. Simply because there's more stability at that 21-day moving average than there is at the 10-day. Simple enough. If you go to the 50, you're really looking at your buyers being mid to large institutions that are buying and trying to protect that level. They feel safe buying here, so they buy here. And then if we drop down to the 200 moving average, that's usually where you'll see the big boys really come in, where you'll see the very large funds, like your pension funds, like CalPERS, and guys like that who are going to step up and try to defend those areas because their time horizons are 5 or 10 years out. And that's a decent spot for them to buy. So that's a rough idea of how to interpret moving averages. Very surface level. We could obviously dive much deeper into the topic, talk about their slope, the different cycles that occur, how to properly buy pullbacks using the moving averages, etc. And I'd be happy to cover those topics in future videos. If you guys have any specific requests, please feel free to drop them in the comments. I want to just keep this video short and sweet, walk you through the basics. If you have any questions, feel free to message me or drop it in the comment section. I'll try to get more of these shorter videos out going forward. And I appreciate you guys taking the time to watch this. Thanks.